Hello everyone, welcome to the 15th episode of me learning how to trade using Forex. So in the last video we went through the intermediate lesson on Forex.com, techniques of successful traders. We went through the how to develop a trading plan and optimizing your trade entry lessons in the course, and today we're starting on the risk versus reward lesson. So let's get started. Risk versus reward. Successful traders won't enter position unless they precisely know where they're going to exit it, whether profitable or not. So, successful traders won't enter a position unless they know precisely where they are going to exit it, whether profitable or not. Determine their planned closing levels. They'll use a risk to reward ratio. This is determined using a risk reward ratio. What is a risk reward ratio? A risk reward ratio is an essential part of trading successfully. It determines how much you're willing to risk losing any trade and how much potential profit you need to justify that risk. Risk reward. How much you're willing to lose on any trade. Against how much profit, how much potential profit you need to justify that risk. In doing so, your ratio will dictate two crucial aspects of your day-to-day trading: whether to trade an opportunity or leave it be, whether you close to take profits or prevent losses. In doing so, your ratio will dictate two crucial parts of your day-to-day trading. So, doing so will dictate two crucial aspects of your day-to-day whether to take an opportunity, whether to trade an opportunity or leave it be, and where you close your trade to take profits or prevent losses. Choosing opportunities. When you trade using a risk reward ratio, you should only open positions that fit your plan. When you trade using risk, you should only open positions that fit your plan. There is no golden ratio that will work for every trader. To choose your own, you'll need to balance how much profit you can realistically expect from any individual trade against how often you believe you can trade successfully. I think we've been through this as well, haven't we? We have, yeah. Right, okay, so what is a risk reward ratio? Because I remember looking at this chart. No golden ratio, balance, no golden ratio, needs to balance how much profit you can realistically expect from any individual trade against how often you believe you can trade successfully. Example, if you choose a 1-to-1 ratio, so for example, then you would want your potential profit from a trade to be equal to how much you're risking on it. If you could lose 250 quid, you would target a £250 profit. In this scenario, you would need to be successful more than 50% of the time to make a profit. Any losing trade would cancel out a winning one, which doesn't leave much margin for error. Lose, win, lose, win, lose, lose, win. For 1-to-2 ratio, so that is if you're losing £250, but you aim for a target of £500, on the other hand, you would earn a profit even if you aren't right 50% of the time. It would take 2 losing trades to cancel out each win. The higher setting realistic profit targets, the higher ratio, the more often you can afford to make the wrong call. But how much can you expect to make from each position? Achieving a close profit target is more likely than hitting a distance one. So a 1-to-3 or 1-to-4 ratio will generally result in substantially fewer winning trades than a 1-to-1 or 1-to-2. Much will depend on your trading style. Day traders, for example, might need a lower risk-reward ratio. Achieving large profits within a single day is tricky. Using longer term positions, meanwhile, means you can target higher rewards. Lower risk-reward ratio, so that's like a 1-to-1 or 1-to-2. With a ratio in place, you'll be able to make an informed decision about each potential position. Can the opportunity deliver the return outlined in your plan? If it doesn't, then move on to the next one. Closing positions. To control the risk on each trade, you can use stop losses. To control stop losses can be used. You'll want to place your stop loss at a point where your prediction has been proved wrong. Place stop losses at the position where your prediction has gone wrong, has been proven wrong, has been proven. For example, if you're finding positions using pullbacks and breakouts, then your stop loss could be set where a fake out could be confirmed. Remember, the fake out is when it doesn't actually pull back out again. So, not pull back out again. So it's like if your thing goes like the and that bit there is a pullback, and it goes back up again. A fake out is and it goes drop backs down again. That's a fake out. Alternatively, you could place your stop just beyond the recent support if you're going long, or resistance if you're short level. That way, if the market begins a substantial movement against you, you can limit your losses. Just beyond the recent support. They still haven't mentioned what support or resistance means, so. Or have they? They have mentioned, and I'm just being dumb. Or could place your stop just beyond a recent support if you're going long, or resistance if you're going short. That way, if the market begins to move, sustained move against you, you can limit your losses. Right, okay, taking profits. With a stop in place, the level at which you can take profits is determined by a risk-reward ratio. So, with a stop in place, the level at which you take profits is determined by your risk-reward ratio. For example, if your ratio is 1 to 2 and you've set a stop loss 20 points, then you'll look to exit 40 points of profit. You might want to consider adding a take profit order to automatically close position at your chosen level. That way you know you can secure a return if the market hits your target. How much can you risk? Your risk reward ratio will go a long way towards helping you trade successfully, but it won't stop you from losing all your equity if you risk too much on each trade. As we discovered in the strategies and risk course, if you allocate 10% of your balance on each position, then you only need 10 consecutive losses before you're wiped out. Drop that down to 2%, you have a much larger margin for error. Okay, test your knowledge. You have an open position with a stop loss 90 points below your entry level and your risk reward ratio is 1 to 3. So risk, where should you aim to take a profit? 3 times 90 is 270. Your risk reward ratio is 1 to 1.5 and you want to earn 7,500 from a trade. How much should you be willing to risk? 7,500 divided by 1.5, so that's 7,500 divided by 1.5, 5,000. Okay, running profits. One of the first rules of trading is to cut losses early while letting profit run. But how do successful traders put this in practice? Okay, this is new, I think. One of the first rules of trading is to cut losses early while letting profits run. How does successful running profits is an easy concept to grasp. When you have a successful position on the market that's moving in your favour, keep the trade open to squeeze as much return from it as possible. But when the markets are moving fast, it can be tricky. After all, you don't want to keep a position open for too long. You might see your profits diminish or even turn into a loss. A good guideline to start with is to stick to your trading plan as much as you possibly can. If you're a beginner trader, then letting winning positions run to their profit target can be difficult, let alone keeping them open for even longer. However, if you notice that your profitable trades could have earned you more if you let them run, then you might want to consider actively managing positions. Right. Actively managing positions. Yeah, we have done this actually. Actively managing positions. If you notice that your profitable trades could have earned you more if you'd let them run, then you might want to consider actively managing positions. Actively managing your positions. Actively managing your positions requires a more hands-on approach than sticking to your trading plan. Instead of closing your trade when it hits your profit target or maximum loss level, you shift them to reflect changes in the market. Positions actively shifts. Profit target or maximum loss level to reflect changes in the market. The most common method of achieving this is to adjust your stop loss. Once your position reaches a certain profit level, you move your stop closer to the current market price. This reduces your potential loss on the trade and eventually means you can start to lock in some profit, enabling you to target higher total return. Tip: you should only ever move your stop loss in the direction of your trade. On a long position, only move the stop loss up. When going short, only move the stop loss down. Moving your stop in the opposite direction to allow the position more room can be a recipe for disaster, putting you at risk of large losses. So, should only ever move your stop loss in the direction of your trade. On a long position, only move the stop loss up. When going short, only move the stop loss down. So when going long, that means when you're buying, only move the stop loss up. When we're going short, that means when you're selling, only move the stop loss down. Moving your stop loss in the opposite direction to allow the position more room can be a recipe for disaster, putting you at risk of large losses. Traders will often begin by moving their stop loss to the point at which they entered the trade. When your stop loss is equal to your opening price, you won't see any losses from your position, even if the market reverses, unless it gaps past your stop. Example: you open a buy position on gold at 19,000 or 1,900 with a stop at 1,860 and take a profit at 1980. Gold's price rises to 1940, so you move your stop to 1900 and you take profit to 2020. If gold then reverses back to 1860, then your stop will trigger at 1900. If gold continues to rise, then you can keep managing your position to start locking in profit. When should you move your stop? Some traders will only move their stop in specific conditions. For instance, they might wait for the market to hit a new price plateau, break a key support resistance level, or move into a consolidation pattern. Alternatively, you can decide set levels at which to move your stop. You could, for example, move your stop loss whenever the market moves by 50% of your initial risk total. In the example above, your risk total is 1900 minus 1860, so this example here, 40 points. 50% of 40 points is 20, so you move your stop loss up 20 points whenever gold moves up 20 points. Right, okay. Scaling in and out of trades. You might also want to consider scaling in and out positions to increase profit or realize returns. Scaling into trades involves adding new positions to increase your exposure to a market that is moving in your favor. Scaling out involves progressively closing out parts of an open position to realize profits early. Consider scaling in and out of or realize returns. Scaling in to trades involves adding new positions to increase your exposure to a market that is moving in your favor. Scaling out involves progressively closing, isn't it? Closing out parts of an open position to realize profits early. So we'll cover both in more detail in the advanced risk management course. Right, okay, test your knowledge. You're planning on moving a stop loss down 50% whenever your short EUR-GBP position earns 50% of your risk total. You open up your trade at 0.9040 with a stop loss at 0.9064. When would you move your stop? So whenever you short 50%, 50% of that is 20, right? 40 of 20, so if that goes down to 9020 minus 20 off of that, 44. Nope. Not 44. You're planning on moving your stop loss down 50% whenever your short earns 50% of your risk total. You open your trade at that with a stop loss at that. When would you move your stop? Whenever you're planning on moving your stop loss down 50% whenever your short earns 50% of your risk total. You open your trade at that. So you risk 0.9040. 50% of your risk total. 50% of that. 9040 with a stop loss at 0.9064. When would you move your stop? What's halfway? 0.964 minus 40, 24, 24, 12, plus 12, 52. No. You minus 12? 0.928? Right, okay. Where would you move your stop to? That. Right, okay. Tips for trading volatility. Volatility is an enticing prospect for traders, offering the opportunity of fast returns if you're willing to take on the additional risk. When the markets are on the move, here are a few tips to help you stay profitable while keeping your risk in check. Use trend lines. Yeah, this is what we've done already. So trend lines are an invaluable tool for trading volatility. So then enable you to cut through the noise and see the underlying trade in the market even when it's experiencing wide upswings and downswings. Before you consider opening a position on a volatile market, draw some trend lines to ensure you know precisely how it's performing overall. It's also worth identifying where key levels of support and resistance are forming, remembering that previous support often turns into resistance and vice versa. Before you consider opening, draw some trend lines. Draw some before opening a position. Don't just follow the herd. One significant cause of market volatility is the herd mentality. As more and more traders jump onto an asset, they drive its price further because there's more demand with the same number of supply. This causes more traders to join the opportunity, which only adds to the trend. While riding these trends can provide handsome profits, it's a rarely good idea to trade only because of the fear of missing out on a popular opportunity. Instead, make sure you do your research properly. Once the herd mentality turns, things can get ugly quickly. So, don't follow the herd mentality just because everyone is buying doesn't mean you have to buy. Of course, you can also take a contrarian view if you think a trend lacks the substance. However, markets can remain irrational for a long time, so that before you trade against the trends, make sure the opportunity fits your trading plan. Take your position on news early. When major market events such as NFP, interest rate announcements and more occur, your best bet might be to stay out of any related markets entirely. However, if you do want to trade the fallout, you'll want to ensure your opening position before the release hits. Open positions before news gets released. To make this work, you'll need to do a lot of research so that you can make your call on how the release will affect your chosen markets. It's worth checking any other related releases that might offer a hint to the final figure. If you're trading NFP, for example, you could try to get a gauge on the overall employment for the month by checking the ADP employment report, jobless claims and more. Once you're able to make an educated guess about where the release will land, you can decide how it might play out across the markets. Remember though, that analyst predictions for a release tend to be priced in early. If you think the analysts got it right, there might not be much volatility at all, because everyone's going to be jumping on board, right? Filling the gap. We've already seen how markets can jump from one price to another when trading is closed overnight or over the weekend. Often it will then fill the gap by returning to its previous closing price. So about here pretty much. In the above example, the AUD/USD gapped 35 points over a weekend. That's that, due to some poor economic data from China. But then over the next 12 hours, it steadily climbed back to its original price. A simple way to trade volatility is to look for these gaps and trade a subsequent return to the pre-gap price. But just like any other strategy, it doesn't work every time, so be sure to place your stops and targets at reasonable levels. The pre-gap price. Trade when gaps are present. That's a really bad way of saying it, but US jobless claims in the above US jobless claims come in above expectations in July. Would that signal that NFP will come in high or low? NFP, I'm pretty sure I wrote this down, but what does it stand for again? NFP, non-farm payroll, number excluding farm workers. Oh right, okay, yeah. US jobless claims come in above expectations, low. The FTSE 100 closes 6,900 on Friday, then opens 6,950 on Monday morning. How would you trade to fill the gap? You short the FTSE. Cool, okay. So we've done the techniques of a successful trader, haven't we? Trading, running profits, trading volatility, yep. Mastering Forex. What moves currency prices? Right, okay, this is new. So, mastering Forex, let's make a new below. Mastering Forex. What day is it today? 15th 01/2024. What moves currency prices? Forex pairs are constantly fluctuating in price due to a wide range of factors. So Forex pairs are constantly fluctuating. It is a key reason why foreign exchange is so popular among traders. However, to understand Forex, you need to know precisely what might kickstart a new trend in your chosen market. You'll need to know precisely what might kickstart a new trend in your chosen. Here's a breakdown of the biggest drivers of Forex volatility, starting with the biggest of them all, central banks. Central banks and Forex. As we've covered in the fundamental analysis course, central banks have a significant say over multiple financial markets, but they probably have some of the most direct impact on currencies. Even if you're planning on a purely technical approach, it pays to be aware of what the central bank behind your chosen currencies are planning. To help you get started, here's what to watch out for if you're trading USD, EUR or JPY. USD. The US dollar is the most traded currency by some distance. It features in every single major pair, is used as the world's reserve currency and forms a backbone of financial markets. In practice, this means that every popular FX pair is hugely influenced by the actions of the Federal Reserve. So USD is the traded currency by some distance. It features in every single major pair. In practice, it means that every public is usually. In practice, this means that every popular FX pair is hugely influenced by the actions of the Federal Reserve. Most importantly, the Federal Open Market. Most importantly, the Federal Open Market Committee, which meets 8 times a year to set the base rate for the US dollars. As ever, the markets will look for any clues on the future direction of interest rates. Any sign that interest rates may rise in the US could see USD rise in value. So, any sign that interest rates may rise in could see USD increase in value, because if interest rate rises, then it's going to attract more investors into putting their money into that currency. Any indication that they'll fall, meanwhile, can cause USD to fall. Any indication that interest rates will fall could see US decrease in value. So watch for CPI figures from the US, that's Consumer Price Index, from the US Bureau of Labor Statistics, and of course non-farm payrolls. Therefore, watch for CPI figures from the US Bureau, Bureau of Labor Statistics and non-farm payrolls, NFP. Why? Because high employment is because high employment is the primary goal of the Fed and the sign of growing economy. Ah, right, okay. because high employment is a primary goal for the Fed and a sign of a growing economy. If unemployment is low, a fall in interest rates may be on the way. If employment is low, a fall in interests may be on its way. If employment is high, then the Fed might be able to raise interest rates. If employment is high, then the Fed might raise interest rates. Remember though that the USD going up or down will have a different impact on different pairs depending on whether the dollar is a base currency or quote currency. However, remember that USD going up or down will have different impact on different pairs depending on whether the USD is the base or quote currency. EUR, the second most popular currency in the market, is the euro, chiefly because it forms one half of EUR USD, which makes up an overwhelming majority of global forex trading. The euro also features an important minor pair such as EUR GBP and EUR CHF. Where the US has a Federal Reserve, the European Union has a European Central Bank. The second most popular currency is the euro. The US has the Fed. The EU has the European Central Bank. Here the Governing Council meetings are the key ones to watch. The Governing Council meetings are key. They take place every 6 weeks and are used to decide the rates national central banks can use with commercial banks. Are used to decide the rates national central banks can use with commercial banks. To decide the rates national central banks can use with commercial banks. JPY. Central banks don't only affect currencies by setting interest rates, though sometimes the value of a currency can inflict harm on an economy, which can lead to a central bank stepping in. Japan's economy is depending on exports. For example, countries with high exports tend not to want their currency to gain too much value. Take a look at the table below and see why. USD JPY value 80, price of TB in US dollars, revenue in Japan. Oh, so they want it as low as possible so they can... Revenue means profit, right? Money generated, yeah. If JPY is too strong against USD, which is this, then Japanese exporters make much less money. They might have to increase their prices, which could see overall sales fall. In this instance, the Bank of Japan might flood the market with JPY by releasing reserve cash. The supply glut should cause the yen to depreciate, meaning USD JPY rises. Ah, right, okay. So central banks don't only affect currencies by setting interest rates. Sometimes the value of currency can inflict harm on a economy. Japan's economy is dependent on exports. Countries with high exports tend to not want their currency to gain too much value, as the exporters will make less money. Therefore, they might have to increase their prices, which could see overall sales fall. The supply goods are closed, meaning taking advantage of intervention is particularly challenging because unlike interest rate changes, it isn't usually communicated to the masses until after it's been occurred. However, there may be clues that intervention is about to be implemented, particularly if a central bank repeatedly states that its currency is historically overvalued. However, at the time of it is difficult to gauge and is usually a surprise. Flood. By releasing lowering the value of JPY. Other factors to watch out for. Government announcements. Governments are responsible for fiscal policy, which also has a major impact on currencies. Also has a to fund a new infrastructure project, for example, the government will have to borrow money in the form of bonds to sell to investors. Fiscal stimulus measures are agreed upon by governments, and sometimes a vote needs to take place to measure the stimulus law. It pays to keep up to date with breaking news events to ensure you don't miss these crucial decisions. Market sentiment. In the simplest forms, fear can turn a falling instrument into an all-out panic, and greed can turn a rising market into a blind buying spree. The crisis in the Eurozone, and in particular Greece in the 2010s, led to an extreme selling of the EUR currency, as fear dominated mainstream thought. Soon after, though, greed kicks in and drove the currency to levels that were detrimental to employment and inflationary dynamics. The European Central Bank had to force devaluation through a variety of market mechanics. While it may be easy to point out the effect of fear and greed at markets after they have acted upon them, choosing the moment when they flip in the present is difficult. Sentiment. greed and fear. Not all news events are equal. 3 in news. For instance, as a general rule, employment reports tend to move markets much more than manufacturing sales reports. News. Not all news events are equal. Employment reports tends to move markets more than a manufacturing sales report. And the retail sales figures rouse things up more than a monetary supply report. A retail The economic calendar is a great source to help you determine which reports provide the most punch. It's key to help you determine which reports provide the most punch. While not all important news events move the needle when their number is called, they have the highest probability of doing so, and knowing when the markets will move can be one of the greatest advantages you have as a trader. Finding events with the Forex.com economic calendar. Head over to economic calendar, hit show filters. Here you can filter events by category, and volatility. Country, category and volatility. Choose the countries that are related to your chosen pairs, then hit apply filters. Now you only see events in your markets. The marker on the right tells you whether high, medium or low volatility is expected. You can also see any consensus on where data might land in the consensus column. Cool. Alright. Alright. This is good enough time. So we went through quite a bit today. Next video we're going to start on managing emotions in Forex trading. So yeah, let me just save this. Thank you for watching today's video, and I'll see you next time. Peace.